please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
A major triumph that has been scored by the government. The borrowing program has been cut. The expectation of the market participants were that 2.68 lakh crore will be borrowed in the second half after deducting 50,000 crore, which was to be met from small savings and buybacks, and less of buybacks. But now it is only going to be 2.47 lakh crores. A. Prasanna, Chief Economist, ISEC PD, is with us, and in a bit we're also going to be joined by Jayesh Mehta and R. Sivakumar. Prasanna, what a surprise. Rally in the bond markets on Monday?
Yeah, I mean, this is lower than what market was expecting, but also I think one should understand that some of this reduction had already been telegraphed by some of the comments by officials, of course, unnamed, unknown officials which have been coming out in the wires over the last 1 week. So I think market was prepared for a bit of a surprise, and that's why we saw a rally today also. But yes, I mean, on this you could expect a further rally happening on Monday. Okay,
and also in October, the weekly borrowing is only 11,000 crore as opposed to the average 12,000 that has been the case. Will that add the shortage of less than expected supply?
No. So in that scenario, anyway, the borrowing is going to stretch till March, right? So normally the government borrowing program gets over by the end of January or the first week of February. So you have to balance it out. But yes, I think initially at least the lower weekly borrowings will help because it will also mean lower supply of the 10-year paper on a per week basis. So that could help.
So what is the kind of range you are looking at?
It's possible Monday the market will test 8%. It will go below 8%. So maybe we could see a 5 to 7 basis point rally. But over a slightly longer period, I don't see market sustaining below 8%. For that, we need other good reasons also, maybe on the monetary policy side or from some global variables. But purely from a supply point of view, yes, I mean the environment has slightly improved. There's no doubt about it.
Jayesh, Sivakumar, just stay on. We have Prasanna only for another minute or two. That's why I was concentrating the questions on him. Prasanna, will there be any doubts of the ability to meet this kind of a borrowing program? I mean, the Secretary, of course, was very confident that despite Ayushman, despite MSP, it won't be a problem. But is there a possibility at all of an overshoot? Brave words now, but regret later. I mean, the GST collections also are not quite matching up.
Yeah, so, I mean, we still believe that there is a very high probability of fiscal slippage, but of course, government has been reiterating again and again that they will try and meet it, so probably we have to take them at face value also. My sense is even if there is some slight slippage, I don't think they will come and tap the bond market, purely because of the experience last year and how we are doing this year. So to that extent, I think bond market has kind of, in a way, disciplined the government is what I would like to believe. It's possible that they might draw down the cash balance and meet any slippage, which if it happens at all.
Yes. And final question to you. Does this remove one problem for the Reserve Bank? Such extraordinary fiscal discipline proof shown by the government. Does it change the MPC's view?
I would think that, I mean, of course, the MPC or the RBI, they always warn about fiscal slippage. But by and large, what we have seen is they do take the government's promises at face value. So my sense is at least till now, I don't think any fiscal slippage has entered into the calculations as far as the MPC's assessment.
No, I meant better than expected behavior since the borrowing program is even lower than they expected. Does it soften the need for a rate hike?
Not necessarily. So obviously, it's what you're saying is correct as far as the market borrowings are concerned, but the fiscal deficit still remains the same. So if you're going to borrow from small savings and you hike the rates there, ultimately the effect will come onto the economy in one form or another.
Oh, right. Fair point, Prasanna. Thank you very much. We had to quickly wrap up with Prasanna since he won't be available now. Jayesh and Sivakumar, welcome to the discussion, and I think we are also joined by Upasana Bharadwaj. Jayesh Mehta, how do you think the bond markets will respond? Your first reactions to the borrowing calendar?
So to that extent, I think 50,000, even where people were looking at it, is more like unofficial, unnamed official and all that. But so that's also a tick mark done. And 20,000 is a good news. Definitely we'll see some rally on Monday opening. But there are a lot of challenges, right? So you have policy on Friday, you have a lot of things happening in the financial market at this juncture, locally and, of course, globally. So that's where the challenge is, right? So most importantly, are we going at 25 on 5th October or are we going on 50? That's where people will look at. If we are at 25 with this borrowing number, definitely we will be sustaining much below 8%. That's for sure. And the way the financial market have been behaving, particularly on the credit side, I would expect a lot of liquidity to be pumped in will be required.
Oh, yes, there will, of course, be more requirement for OMOs or open market purchases of bonds. Let me get Shivakumar also into the discussion. Shivakumar, what does this mean for the bond markets? This 20,000 crore is a bonus, isn't it?
It is up to a point. I think your previous two guests have said the same thing, that there might be a small relief for markets from this reduction of about 20,000 crores. But in the larger scheme of things, it's still relatively small, and it's just a substitution of another form of debt, which is small savings. This is not a change in the deficit numbers. But yes, from a market perspective, I think if the government reduces the borrowing, it's always welcome.
Okay. And you too expect it would dip below 8%?
That's a tougher question to ask. I mean, we have seen this whole Italian issue which is propped up today, and we'll need to see how that develops over the weekend and if there are any other developments. But broadly, I think, yes, you could see a relief rally from the markets. You could see it go down. Today's auction, RBI did try to send some kind of a signal by devolving part of the bonds. So to that extent, it does seem that RBI may be trying to cap yields. So the combination of all this could see some softening early trades on Monday.
Okay. Yeah, I guess there's crude and other variables as well. Upasana Bharadwaj, what do you take away from the government's show of fiscal discipline, reducing its borrowing program? Well, they've retained the fiscal deficit number, of course, at 3.3, but won't tax the market.
Well, Lata, I think clearly from what I gather, I haven't really seen the details, but you're telling me that the total borrowings is even lower than 2.6.
Yes, 2.47 lakh crore versus expectations of 2.68 lakh crore. Yes.
So somewhere this was an announcement which was already done last week through certain sources. So somewhere markets were already hoping for this kind of a number, number one. And I think, yes, clearly this is a positive surprise, and it does kind of provide some kind of comfort to the market that the slippage may not really happen on the fiscal side. Probably somewhere the government could be getting comfort from the higher small saving rates that they have provided for, which could help them garner more revenue from the NSS's collections. So there is a possibility that, that's the comfort they're getting. And of course, like someone else mentioned too, that maybe a little bit extra drawdown of the cash balances could happen over the end of the year, which could also help them, kind of offset this kind of, reduced borrowing. Okay. So yes, from the market's perspective, this is slightly positive. And it could result in a brief break of 8%, 10 years. But having said that, of course, over the weekend, how the crude oil prices flare up. And of course, that becomes extremely important to watch out for. So it's not just about this. Okay. But of course, we should remember that OMO purchases would also would continue, if not probably at the same pace as what was earlier anticipated, because the fall LCR requirement has somewhere provided the liquidity comfort to an extent. But nonetheless, I think OMO purchases would remain, which would also provide comfort to the bond markets as we go into this quarter, the coming quarter.
Okay. Now we are getting more details about the spread over the various papers. I think 1 to 4 year paper is, I think, 20%, if I'm not mistaken. I'll just have to remember. But the important part is 10-year paper is 30%. 10 to 14% tenor will take about 30% of the load. How does that square, Jayesh, as expected?
Yeah, this is as expected, right? And I think more importantly, I think the key question is going to be what happens on 5th, right? So
what happens on, sorry?
On the policy day, right? Sure. Whether it's 25, whether it's 50. I think people now going to move beyond all this. And if it is, as of right now, I feel it's going to be 25, but you never know. So if we have 25, then definitely this borrowing program reduction, gross borrowing program reduction, and infusion of liquidity, they will have to do it. Even this adjustment they have done is not a net infusion in the system. It's just allocation release, right? So from that perspective, they will have to infuse liquidity. So I think we are good on that. But the big key question is the 5th October.
Yes, of course.
So, and we don't have time enough for 5th October. So Monday the market opens, 2nd is a holiday, 3rd, 4th.
Yeah. No, I'll come to the MPC in just a bit, but I want all three of you on another issue as well. Sivakumar, this good feeling about the bond market. First you had the OMO, and then you had the release of 2 percentage points more of SLR being counted as LCR, and therefore no short-term paper CDs hitting the market. And now a third feel-good factor, all for the government bond market. Will some of the good feelings seep into the corporate bond market?
Well, I think two of them, that is the OMO and the reduction in or the carve-out for LCR, certainly are going to help the overall system liquidity, and which will definitely reflect in some way in sort of the money market. You yourself pointed out that let's say banks may not need to issue so much CDs if they have a carve-out in LCR, so that reduces the stress on the money markets already. So I think RBI is certainly taking the first steps towards easing liquidity. I think RBI in its press release pointed out that about 1.8 lakh crores is drawn under the various term repo facilities, which indicates that the system is quite drawn, and therefore this addition of liquidity is going to be very, very helpful for the money markets. There's no doubt about that.
Okay. What would you mean? I mean, more deals getting done, or will the money markets have even the courage to roll over NBFC? At the moment, they're redeeming most of the NBFC CPs. They're not rolling them over. You think rollovers of NBFCs will happen?
Yes, it's going to take a little bit of time for that to settle down. The most important part that RBI can play in this is twofold. One is provision of adequate liquidity, and then second is in some way act as a calming influence on the overall market by not allowing stress or panic to develop. I think it's very important that RBI acts as the super regulator of sorts for the banks and NBFC sector, and in a sense provides an oversight at the same and liquidity. I think it might be the case that maybe we may have another few days where no deals or very few deals are being struck in the money market. But eventually, the money in the hands of the investors will find its way to deals.
Okay. Your take, Jayesh, do you think it will have a calming influence on corporate bonds? Do you see the money market rolling over, refinancing NBFC paper? They already did. I mean, they've done Tata Power and Rel Jio in the last 2-3 days. Yeah. They've also done Bajaj Finance and Gruha Finance, to be fair. But a large, they've all been very, very short paper. Do these announcements, government bond being less and the LCR, yeah, go ahead.
Yeah, it's basically, two issues, right? When we talk NBFCs, right, what's going to happen now, it's not that whole NBFC sector is going to face problems. It's very categorically, you will have Tier 1 NBFC and Tier 2 NBFC. In fact, Tier 1 NBFCs are going to actually benefit, right? So they will actually get more flows coming from mutual funds and other investors. So Tier 1 will benefit. Tier 2 NBFC or pursued Tier 2 NBFCs, that's where the challenge will be for rollover and stuff. And that's why when I talk about liquidity, one is the normal liquidity they will have to infuse. And because we have, if this thing blows out, we will have stress in the system, they will have to infuse more liquidity. Of course, RBI can't do anything about the credit quality, but they can. The only way they can manage and smoothen the credit situation by infusing a little bit excessive liquidity.
Okay, so more OMOs, I guess, is the plea. Upasana, a final question before we wind up this conversation. The government's confidence with which it has announced, a smaller than expected borrowing program, rather than leave that excess elbow room from small savings for possible slippages later on, indicates they're quite serious about this 3.3%. Does that convince you? Will that influence the market in any fashion?
There are two parts to this. One is whether they can deliver 3.3%. At this point in time, there are risks, of course, because the GST collections are yet not showing a good sign. Of course, there could be offsetters like a good direct tax collection. and maybe a good takeoff on divestment takes place, but yet we need to see that momentum pick up. So even though there might be a slippage, but the borrowing, like I said, could still remain where it is, the lower announced borrowing, because of better collection. So the sources of financing could shift in favor of other sources of financing away from market. But nonetheless, as of now, the risk on the 3.3% still remains.
Oh, okay. All right. Skepticism from an economist, I can understand. Our previous economist also had that skepticism about maintaining the 3.3%. But the government clearly has sent a very clear message at this point in time. Jayesh Mehta, Upasana Bharadwaj, Shivakumar, thank you very much for joining us in this conversation. The message from our experts is that this is better than what the market expected. The market was expecting a borrowing of 2.68 lakh crores. It's come in at 2.47 lakh crores. So to that extent, there could be a rally in the bond markets to the extent of bringing the yield. I think it closed at 8.02. So it could come below 8% at least briefly. And if this spate of good news for bond markets is preserved, then you could perhaps see a little more cheer spreading to the corporate bond market as well. Though at the moment, the cheer is not as much as one would like to have. Also, very good to note that the government is absolutely serious about the 3.3% fiscal deficit. Well, it's over to you, Ritu. The borrowing program has been a positive influence.
Well, absolutely. And we'll watch out for how the bond markets open on Monday. But with that, it's a wrap on this special show. News and updates will continue on the other side. Don't go anywhere.